to the State of the Industry session. Please take your seats. We've tried to get a wide perspective, both from a macroeconomic level, from a grape growing and grape selling level, and then at the retail level as well. So we're going to start there in the middle with Mike Provance from 3x3.
Thank you very much. Appreciate it. So as Kim said, I'm from 3x3. I'm going to go down nearer to my slides to try to help you understand them. We started 2 years ago to build a business because we saw a dark area in the alcohol industry, which is nobody actually knew who bought product from the local liquor stores. You had Nielsen, you had IRI, they covered all the big box stores, they covered all the chains. But when it came to understanding where products like yours are being sold, mainly through smaller stores with 10,000, 15,000 SKUs, there was very little data to tell you about those consumers. And so we set out to build a network of retailers. And these are everything from bulletproof stores in Harlem to chains of 30, 40, 50 stores across the country. We have 1,200 stores that are members of our network today, which allows us to collect roughly $8 billion in transactions, about a little over $2 billion a year in understanding the baskets that the consumers buy, the shopping baskets, what's in the bag when they leave the store, and also collecting data about consumers. And so we have in all of that data 3.5 million addressable consumers. So essentially what we have is the ability to create audiences of 30 to 40 million people where we know who they are, how to contact them, and what kind of buyer they are. Because that 3.5 million consumers, we have shopping basket information for them. So we know if they're a red wine buyer, we know if they're a whiskey buyer, or if they're a beer drinker. Right? And we can build models. And so we're a marketing company that connects shoppers, stores, and brands because we believe that the independent channel is still incredibly important to companies like yours and to the retailers who live in them because they still represent half of all bottle sales in this country. And we want to keep it that way with Amazon and others coming in to compete with them. And we think they will always play a role. I guess I strolled too far away. There we go. So, as I said, what we collect are the actual receipts, every receipt from every store in our network that we're collecting data from, and that allows us to look at things like competitive performance of products. It allows us to look at shopper buying patterns. It allows us to look at how price points are, what the price points are at retail, things that are hard to come by, and to be able to profile those consumers. And so what I did today, in an interest of giving you some insights into what we see happening in our network, is to look at North Coast wines and how they're performing within our network. And so our network, as I said, spans 30 states. Roughly half of those are very dense in terms of the number of stores we have. And so I can give you some very good information around the kind of market share we're seeing in different parts of the country. We'll also look at the buying behaviors of the shoppers. We'll look at price point or price distributions of the North Coast products. So first of all, looking just generally at our network, and so what you're seeing here are the 15 most dense states for our network, and the market share of North Coast wines in our network across, in this case, 16 states. And as you can see, Florida performs very well. A quarter of all wine sold there through our network is coming from the North Coast. Northeast is pretty strong. Tennessee and Arkansas tend to be fairly strong. Keep in mind, as you're looking at all these data, the kinds of companies we recruit as members in our network tend to be the progressive retailers. They're the ones who are actively trying to grow. In places like Colorado and Kansas and Oklahoma, they're the ones who are fighting back against the laws that have, for example, taken beer and let it be sold in grocery. And so they're looking for new products and new niche kind of offerings that bring consumers back into their store that aren't going to be available through grocery or through big box. And so these are the ones who are constantly looking at how to improve and expand the offerings in all the categories they carry in the stores. When you look just at the Northeast now, looking at what you're seeing here is a map that shows zip codes by population of white Americans. It's very similar, very correlated to affluence as well. And when you layer on top of that market share for North Coast wines, probably unsurprisingly in some respects, you see that those North Coast wines tend to line up very strongly to dense urban populations of white affluent Americans. You also can see, for example, that, and it's a little bit washed out here from what I'm looking at, but essentially you've got Cape Cod, you've got the New York, New Jersey MSA as being very, about 34% market share in those MSAs, 32 to 34% market share. The opposite end of the spectrum, Buffalo up in the upper left, is only 14%. My hypothesis, I didn't dig deep enough into this data, but I imagine they're taking a lot of the Lake Erie wines in there, and that kind of washes out some of the effect of the North Coast. But you can see that the North Coast wines do play well in markets where spend on alcohol is higher. And so one of the things you do start to see when you look at the shoppers is the baskets for the wines coming from this region tend to be bigger baskets in terms of dollar value. So let me look here at shopper insights for a minute. The way I want you to look at this graph is two things going on, really three things. The color coding, the reds are the wine category, blue is spirits category, gray is beer category. And what you're looking at here is those top five across the top columns, Cabernet, Sauvignon, Pinot Noir, Red Blend, Chardonnay, and Sauvignon Blanc. Those are the five biggest wines from the North Coast selling in our network as a category, as subcategories. Everything below that are the most popular categories in the basket with one of those North Coast wines. So one way to look at this then is Cabernet Sauvignon, Red Blend, and Chardonnay. 10% of the time have another of the same subcategory in the basket. So those shoppers are buying 2 Chardonnays, they're buying 2 Red Blends, they're buying 2 Cabernet Sauvignons. The cab drinker tends to also be a spirits-heavy drinker and fairly diverse in their choice of spirits. By contrast, the Red Blend shopper for North Coast wines tends to focus on wine and beer. And in fact, they're the only shopper in our network of North Coast wines who buys beer regularly with wine. If you look at the Sauvignon Blanc drinker in the list there, what you see that's interesting to me is a lot of red wines show up as being part of the basket. So that Sauvignon Blanc drinker is not a white wine heavy drinker like the Chardonnay drinker is. They tend to go kind of both sides of the house, as it were. And so you begin to see, and the percentages here are small, but one of the things to consider is you're talking about stores in our network that have 15,000 SKUs, and they also sell cigarettes and ice and lottery tickets and other things that make up those baskets. And so what I focused on here is which of the categories of alcohol products tend to be most likely to appear in their baskets. This one gets a little bit interesting as well, also a little bit hard to interpret, but let me start by saying that we're only looking at Pinot Noir and Cabernet Sauvignon, and what we're comparing here is the types of brands that appear more often in a North Coast wine basket versus a basket for all other wine. So the way to look at that is in a North Coast wine basket, you're more likely to see La Crema, Decoy, Meiomi, or Francis Coppola for Pinot Noir. And on the right side, you're likely to see Josh and J. Lore. You're likely to see products, other wine products that are more expensive. So you're getting customers that are not value shoppers. They're shopping for something other than price when they're out shopping in the liquor stores for wines that come from this area. By contrast, where you under-index on the North Coast wines in the baskets tend to be things like 19 Crimes or Yellowtail. And what's interesting is that you start to see some of these wines that are slowing in their growth rate. They're slowing in their growth rate more quickly when the North Coast wine shoppers coming in. And so those North Coast wine shoppers are really investing in bigger baskets, more valuable baskets, which we'll also see in a minute when I look at the price points. So this is a different kind of graph. This is a graph that will show you basically for those top 5 categories I mentioned, subcategories I mentioned, how pricing is distributed at a basket level. So the Cabernet Sauvignon buyer buys the biggest baskets. Their average basket is around $137, and it kind of has a range from $120 to $155. On the other end of the spectrum, the red blend buyer, they're down in the $85 to $105 basket. To put this in perspective, the average basket in the liquor stores in our network is $25. So if you're a North Coast wine buyer, you're on the very upper end of the overall distribution of basket size in our stores in our network. Your customers are very hot commodities for these retailers. They want to figure out how to bring them in. They're a very good partner for the winemakers out here. If I go into a little more specifics, and for this I'll wander a little closer, I'm looking here at retail price across the bottom. Apologies that the numbers are a little hard to read. The fainter yellow is the distribution of price for all other wines. The darker yellow is North Coast wines. And so what you see with Chardonnay, for example, is that it's about $2 on average higher priced in these stores than all other wines in the same category. Sauvignon, by contrast, is about the same. You don't see much of a price shift for there. So it's much more of a price competitive product than Chardonnays are. They're selling more on premium and premium qualities and value. If we look at that for the red category, red wines, you see the Pinot is pretty much layered on top of all other Pinot. So again, it's a price sensitive subcategory. You're competing with all wines at the same price. But by contrast, the difference in Cabernet is about $5, and the red blend tends to be also one that sits almost directly on top of the average price of all other red blends. So in the red side, you've got a lot more price competition than you have on the white side. And that's all I've got. A little bit of a teaser for you of what is happening in the market. There's a lot more depth we could go into, and I'm happy to answer other questions at the end as well.
With that said, we'll pass it on to Robert.
Thank you, Kim. How's everybody doing? Good. So let's talk about the economics of our country and then ultimately just a little sprinkle of what's going on in the wine industry. So this graph right here is meant to tell you what 40 economists who watch the American economy as an everyday piece of business see from last quarter and this quarter. The first column of the data set in the first stop is on real GDP or GDP after inflation. The previous quarter's forecast is higher than the new forecast, which means that forecasters are actually seeing us drift toward what we've been hearing in the news a lot, toward a downturn. So that's here for the next few quarters. Part of that's because of what's going on with China. Part of it's general global uncertainty. Part of it's an economic slowdown in other parts of the world. But also things like the fiscal policy that we saw at the beginning of 2018 after the tax cuts took place. We have not seen the consumption effects, nor have we seen as much of the investment effects that we expected. So as a result of both, forecasters are slowly turning down their forecasts going into the new decade. But if you look at the annual piece, which is right here, you'll notice there hasn't much change at the annual level in terms of the forecast yet. So, two things to get off that. One is that things are slow, but look like they're going to continue to be steady and slow. The second is there's no recession predicted in these numbers till at least 2022. Now, I'm a little more pessimistic than that. I think we're going to float a little closer to technical recession between now and, let's say, 2021, but that's good. Now, with everything else, there's opportunity cost. So, unemployment rates look like they're going to stay relatively low too. And the way that we look at recessions at the end of the day as economists is we look at them as an amalgam of data and not just what happens with GDP growth after inflation. The unemployment rate or some statement of the labor market's another piece of deciding whether or not we're in recession or not. And the current predictions are all somewhere below 4% unemployment for the national economy. Now that is historically low for a historically long period of time. But if you think of gross domestic product growth after inflation as the real purchasing power generated per annum in terms of percentage growth by jobs and by what we're doing in business, those numbers are relatively slow-moving numbers, but the labor market is very, very robust. What kind of jobs are we creating in an environment where we have slow income growth, but a lot of jobs? Are they high-wage, high-value-add jobs, or are they relatively low-wage, service-style jobs that aren't generating a lot of income? Just go ahead, folks. I know you just had lunch. Somebody take a guess. It's one of two. The two. Outstanding. Okay, you took the... Very good. Okay, everybody gets an A for the day. So, it's the latter. We're generating a lot of jobs, but they're low-wage, low-value-add for now. So one of the things we did not see after the Great Recession, and we saw it in little itsy-bitsy pieces, but not in earnest like we saw the previous 3 decades where we had growth, was a supply-side bump that generalized itself across the entire macroeconomy. We saw a little bit of that. You probably went from a flip phone to a smartphone in the last 10 years, so there's your supply-side bump. But at some point, that's going to not have as proliferate an effect as moving as businesses to an enormous number of different types of machines or taking on brand new technology across the board like we saw in the 3 previous growth phases. So part of this is a story about not having as much supply-side growth. The other part is that we are still generating enough demand to hire people back in the labor force. And that's what you're seeing here. And hopefully it's going to hit here in a second. No, it didn't. The payroll jobs growth here is slowing down also because at some point when you have an economy that's grown for this long and really is already this hot on the labor side, it's very tough to keep generating 200,000 jobs a month more and more and more over time. So we know we're naturally slowing down. So the story at the macroeconomy level is we're slowing down, but we do not see recession coming maybe for the next 2 or 3 years still. Part of what the Federal Reserve is doing is they're watching this graph, which is called Personal Consumption Expenditures Deflator, and is basically the most general CPI index you can find. This is where we've been the last year or so, which is on the far right-hand side. I'll highlight it now. I thought there was a screen over there. I apologize. This is where the Fed started cutting rates, and so we've seen this climb of this darker line, which is the core PCE index, or after you take food and energy prices out, which are more volatile, and we want that line to creep up toward the dotted line. So if the Federal Reserve goes every month and has a meeting and says, look, what are we seeing with this red line? If we're not seeing enough movement and trend toward that dotted line, we're going to see more rate cuts. If we see it creep up toward that dotted line, the Federal Reserve will do nothing. And if we see it creep up and trend above that dotted line, they're going to think about raising rates again. So we saw rates increase initially in 2015 and into 2016 because that red line was turning to creep up toward the dotted here. Then it flattened out and got where it needed to go. And then business activity slowed down a little bit, which took inflation pressure down a little bit, which then didn't allow businesses to increase prices fast enough. And the Federal Reserve said, wait a minute, we might be losing a little growth engine in the economy. Let's put a little more fuel in the tank. And that's why they started cutting rates. So if you want to know, and this is all public information, if you want to know what the most likely outcome of the Federal Reserve is going to be over the next 9 to 12 months, you can download what's called the NY Economy in a Snapshot. It's a slide deck of about 18 slides that come out of the New York Fed. This is the third one, and this is also in the binder of the Federal Open Market Committee that decides interest rates in this country. So check that out. That's what's going on with interest rates, at least part 1. Part 2 is this graph, and hopefully you can see this okay. The top line is what the Federal Reserve decides to do. The blue line is the spread between the 10-year Treasury and the 3-month Treasury. Now, why is that important? It's because it's possible that it's a precursor of recession when that blue line, the line that's lower than the top line, goes below 0. You may hear about this in the news called a yield curve inversion. If you've heard that or you know that phrase, every time the blue line goes below 0 is basically a description of that in one part of the so-called yield curve. So this is here, here, and here. And the shaded areas going back to 1985 forward are recessions, the last 3. Okay, so the Federal Reserve has been increasing rates, they stopped increasing rates, and have now started to cut rates. So they went up to a peak, plateaued, and fell. Check this out. Right before the Gulf War I recession, that movement of the Federal Reserve was up, peaked, fell, and timed pretty much with a yield curve inversion in this 10 to 3-month spread. Okay? Then a recession happened. Here's the dot-com recession, here's the Great Recession, and here's where we are today. So why have you heard about news of a slowdown? Why is there a lot of people and pundits out there saying that maybe we're on the precipice of a recession? Part of it is this graph here, because the supposition is that interest rates are one of the driving forces in our economy. I think that is, but I'm a macroeconomist, so that's how I'm trained, and it's kind of my life. But it's definitely telling historically that we're going to struggle a little bit more to put money on the street, where banks and credit unions want to put it on the street in earnest, which naturally wants to slow down the economy. We're not using much credit. So as that credit cycle begins to slow down, assuming that this doesn't change itself, we're likely to slow down. Now, whether or not we're going to get to actual recession or not is an open question, and that's the key, right? It keeps everybody guessing. It keeps markets moving forward. It keeps a lot of us watching the news. Okay, so here's equity markets just to give you some contrast. So this is as of November 1, just because I had to get the slides up before December 1. But check this out. This is where we landed at the bottom of the recession, 667 on the S&P 500. And economists basically watch the S&P. Don't watch anything else out there. It's not worth your time. We've been in a bull market for a long time. But guess what happened right about here? Anybody know what event took place that may also happen in November 2020 right here? Outstanding. Somebody got elected who's currently in office. This is the Trump bump. You may remember when that happened. The stock market went up right after Trump got elected. And this is the big fall we saw in 2018. We went up. We saw another fall and a lot of volatility in that space. Whoops, I went too far. Okay. Where are we going to end up? So all three of these guys asked me, well, what way is the market going to go? That's what you're going to tell us today, right? And the answer is no, I'm not telling you that today. But two things to think about. If you think, and I'm going to try to connect this to the wine industry now, and I've done a little bit of research on this about 10 years ago. One of the things you want to think about is whether or not equity wealth generates consumption demand for more luxury goods. Right? And this has been a huge question in economics for about the last 25, 30 years is we know that people consume from their incomes, but do they consume from their income to come because of their wealth ascending? So if I have a higher portfolio value, does that give me the freedom to buy things I would not have otherwise purchased? Like, let's say, fill a wine cave full of wine. Maybe. That's still highly debated. But let's talk about what's going on, at least in the aggregate. So I follow Silicon Valley Bank and Rob McMillan. He's sort of my insider guy at the aggregate level for the wine industry data. This is over the last 5 years or so. The red line is total cases sold, and you can see that's in decline to a certain extent. The blue line is total dollars sold. So this suggests, at least in theory, that, or not in theory, that as the number of dollars sold is continuing to rise, but the cases are fading and people are moving back up price point a little bit. And we know that that's true. But is this good to have this fade in terms of total cases? Because as inventories start to bounce up, what are you going to have to do to get rid of those inventories? You're going to have to reduce price. So that's where we kind of are, and maybe we're in kind of a twist point the last 18 months. So another piece of this is to think about that change in price point, and these data may be a little hard to read. This is about the same time frame, but basically this is after we saw price point shifts when the Great Recession ended down the ladder very quickly. This is a way of seeing us going back up the ladder, where the first square, or the first rhombus, kind of shows you that slow back down up toward $10 a bottle, at least people saying, okay, I'm feeling good about it. I'm going to start walking back up from what might have been a $3 or $4 wine. Now I'm going back up towards 10. And we're seeing some ascension up in the $10 to $25, $30 range, but not quickly. Still an amazing amount of the market being sold between $5 a bottle and $15 a bottle at retail. And so if you're in luxury wine business, the one thing is it's been tough to get back into market and sort of stay there, and it's become a little bit more competitive. The one thing I also get asked about is if a glut has now come to Napa Valley in terms of grapes, is that going to ultimately reverberate throughout the valley in terms of the valley's economy? And the answer is probably not. What happens on the dirt does not necessarily change what happens in the hotel or the restaurant, but it does lead to kind of a weird mixed bag in terms of pricing in the wine industry. So watch for that going forward, that ascension really did not happen in earnest and hasn't stuck yet. We'll see how it goes. Here's another graph. This actually, I thought the source was on here, and it might have got covered by the graph. This is table wine consumption in the United States on an annualized basis and the changes. I did this because I thought it might be kind of neat to show you that these are the last 6 recessions and the way people have changed their consumption of wine, at least in the United States, around recession. So you can sort of see a fade begin before recession happens. In most cases, we can kind of keep this as just a huge anomaly in the 70s. But you think about the 80s when we kind of broke out more in the United States on the luxury side, and we sort of changed the way that wine was consumed in the United States. We see that growth has been above zero for some time with a couple of sort of pre or during recession issues. And then we had a little bit of a wobble here since the Great Recession, but it's fading back down again. So is this a sign that we're having a natural fade in consumption or not? And Damian Wilson, who's at Sonoma State, who does a lot of research in the wine industry, actually believes that the biggest issue right now is the conversion of millennials to wine drinkers, and that if that doesn't happen, that as boomers naturally age, they're going to naturally age out of buying luxury wines because their wealth is going to shift and their income is going to shift in a way that they're no longer going to consume at the rate they are now. So if your wine clubs are full of people between the ages of 55 and 75 and you've just been grinding those guys to death the last few years, be thinking about that transition and that twist. So with that, just to wrap up real quick, China has been this kind of funny question in the market. It's been this sort of shiny object like a fish going around and saying, oh, there's the hook and I'm going to run toward the bait. But China, if you don't know, is mainly a rice wine market, almost 90%. And then the French have their talons deep in that market otherwise. So getting into that market, even though it's very tempting to say there's 2 billion people who can consume wine at some point from my winery, God, that's easy to sell, right? Don't bet it's going to change much anytime soon. And of course, trade policy is not helping there either. The dollar strength, if it continues to kind of be relatively strong because low interest rates are happening here, but low interest rates are also happening around the world. So we're still drawing in money from the world, even though we've been cutting rates, which is just amazing as a macroeconomist. Like, God, how is this happening? But they're still drawing in. Watch the dollar strength to basically stay relatively strong, and that might also change the way that we see exportation. The longer term thing for me, folks, and this is just something to think about in terms of the state of the wine industry, is if we go into a slowdown, the next twist will be what happens on the other side in the long term. Will we see some of those questions answered in terms of baby boomers continuing to consume wine at relatively high price points, millennials who are bombarded with now spirits revolution, beer revolution, red wine and white wine also bombarding them? Where are they going to pick in that mix? And how does student lending, job growth, wanting to buy a home all interfere with relative luxury consumption? We'll see. But that market segmentation is a big thing, and you guys already heard some of that as we heard from Mike. So I'm going to hand it off now to Glenn. Thank you.
Okay, good afternoon, everybody. I'm going to give you a little bit of overview of the grape and wine industry. Two excellent presentations before me, really about trying to break down where the market sits. I'll talk a little bit more about, where the reality sits. At least those are directly in the business, or at least what we're seeing. So, let's go this way. That's how it works. That's a move I had to get down. I wondering what you were doing that for. So I'm an owner at the Ciatti company. We have offices, we're globally based. We just opened an office in China. It's a tough market. And so we do a lot as a broker between buyers and sellers and helping to put deals together. And in doing that, we get a chance to understand the market. So we kind of read the tea leaves about what's going on. So we'll share with you some of the tea leaves, things that we're seeing from our perspective in today's market. So this is the only slide you got to look at in one sense. So if you want to leave now, feel free. But it's just kind of where we sit with the California market in terms of an overview. We've had sluggish sales growth. A lot of this started from our perspective in 2017. When you look at Gomberg numbers, we started to see shipments slow down. The other thing you started to see in that same time frame is this premiumization that kind of overtook us since 2008, 2009, and things buying up, this luxury good consumption. We saw on the wine end, we started to see those rates still be up, but a declining growth rate. So the numbers weren't growing as fast. So those two things, we still look at the issue we find ourselves in today in general as a sales issue, not a supply issue. So sales started to slow down first in terms of what was happening in the wine case good market. Now, not that anybody knew or planned on it, but we had a fairly large 2018 crop. Maybe an understatement in terms of the timing. So we had a large historic 18 crop. So that exacerbated and has compounded where we sit with some of the sales slowdown. And that's why we think where we sit today. is working through that inventory of 2018. And the interesting thing is it's high cost inventory, right? And we'll talk about that in terms of how people were buying grapes. So that's the challenge I think the industry's trying to deal with now, is how do we digest that? The good or semi-good news is the crop was average. It wasn't short in 2019, but we think average, and we'll talk a second about that. But what we've seen from those conditions is this bulk market and spot grape activity slow down. In some cases, you would argue, depending on what you have for sale, non-existent. And then what we've started to see too with that, bulk inventories building and continuing to remain high. And we'll show you some examples of that. So where we sit today is we're in this new market reality. It's not 2016, and you can't manage it like it's 2016. You have to adjust your expectations, is kind of how we're looking at the current marketplace. So I just had a few wine sales slide more on the macro level that I was borrowed and begged. But if you look at U.S. shipments, these are through the first 6 months, Gomberg-Fredrickson numbers, we have a sluggish sales case good environment. Total California wine through the first 6 months is down 2%. You can see domestic flat. We still have exports, right? And that's probably some price related, strength of the dollar, but you can see down almost 30%. That's been a challenge. That was a growing segment for us for California wines. Imports, case goods, are still growing. They're up 5%, right? Whether that's the millennial consumer and how they look at and their loyalty, that's some issues there with pricing. We've seen that grow. Now bulk is actually bulk. These are bulk imports that are going into some California type wines. Those are declining, and that's really because we have inventory at home. People have California inventory, so maybe they're not reaching out and bringing that wine in because it's a way to work through their inventory. So total U.S. wine market, 1%. And what that creates, and I think what, well, I've got one more slide. I was ready to close there. But so this is Gomberg numbers based on 750 equivalent pricing. And so you can see here, hopefully, there we go, that in red, and you can see where it's negative, that those are down. That's actually red. You just got to go with me on that. And so we have below 9, basically a declining volume market. The scary thing is if you go, here and below, it's like 65 to 70% of the volume share of our business in the wine, I think you were talking about this, Robert, is in that lower price category. So there has been some pressure on that, except for premium bag in the box, which is really a convenience product as we look at it. But you start to go premium, premium plus, super premium luxury, they're still growing, but those rates aren't as fast as they were growing. And our belief is when you were in 2016, 2017, we didn't have big crops, inventory was declining, bulk available. Marketers and sales guy who are eternal optimists said, we really expect to grow at 10 to 15%. So we see a lot of wineries, their expectations were they're going to be at 10 to 15. So there's growth numbers, but they're not where they expected to be. And coupled with, we have extra inventory in 18. So that's created some challenges there. And I got to be careful on my time, but they'll shut me off. The other thing is you look at the most recent Nielsen numbers, 52 weeks I was able to garner. The overall 750 equivalent price per 750 for total wine is up about 40 cents. I think it's 30 or 40 cents. When you look at 11 and above, every category at 11 and above is down versus 52 weeks ago in terms of price per 750. So where we're taking price back is the higher value type products, right? Because you're really trying to figure out how to sell those in the marketplace in a really difficult time. So this is kind of the thing we go, oh shoot, right? So if you have gray hair like me and you remember 60 Minutes and all this stuff in the early 90s, we've had a pretty rapid growth of consumption. We've been in a blessed industry in many ways. But what we're seeing is this slowing down, this, where the circle is, and that's the concern. Does this sluggish market remain? How do we look at different segments, millennials and Gen X, and what's going to happen? So that's the question that's hard to answer. So that gives you a little, in our perspective, what's driving some of this in the marketplace. And just to see what those results, we're going to talk just quickly about what we crushed in 2019. We think it's around 4.15 million tons. I mean, here's how we figured that out. right? Because the problem we have is there was grapes left on the vine in virtually every major wine growing region of the state. So it's really hard to go what was crushed. But we think it's going to be around 4.1. It was about 4.28 million tons in 2018. The interesting thing about that big crop in 2018, you're going, that's not that big. But you got to remember, in Napa and Sonoma, the increase in both those areas from 2017 was 30%. So a lot of that big crop was where the biggest increases were some of the coastal areas supply at higher value. This is an interesting way. I've never done it this way before, I have to say. Just in terms of taking a coastal perspective, real quick, in terms of harvest, we crushed about 588,000 tons last year in terms of North Coast. If you take those counties, put them together, we think, again, with a semi-educated estimate, we're going to crush around 520,000, so it's going to be down. Part of that, there's numerous reasons. It's just not as big as it was in 18. But when you look at the overall, the crop feels pretty normal. We saw some capacity issues because a lot of people had their 18 tanks full with wine, and they're like, I got to crush 19. So there was some capacity issues as we went through this. We had the fire challenge that, most of us in this room, and only thing there's a whole bunch you could talk about there. We can ask some questions. I just think we're an amazing community. And just to be thankful for where we get to live and the people we get to work with, how the first responders responded, and how the community supported itself. So I just think we're pretty lucky to live where we live because of the people we get to live with. But the quality was excellent, so that was great. I think we've heard that in general across the board. But when you look at the market, buying activity is very quiet. And it really wasn't about price, it was about need, and nobody had a need for supply. They really were pulling away. We had no late season buyers, cleanup buyers. We'll talk about wineries or sellers. And there was some pressure on quality and yield. I think it's like, hey, if you want to drop some crop, the wineries like, that'd be fine. Just make another pass. We'd be happy with that, right? Because they didn't need the fruit. So there was some pressure. I think everybody was relatively fair with how they approached that. But if you had a vineyard plan you hadn't looked at in 5 years that the winery had given you, this year they might be emailing it to you every couple of weeks to say, by the way, here's what we need to do. So that's kind of what we see in different markets in the industry. So to take a look at bulk and where we sit there, so this is Ciatti list bulk inventory of the clients that we work with, and we try to work with everybody. But you can see on the left bulk gallons available, and this is total gallons by variety for the state of California, all vintages. So it gives you an idea, and this is all January, so we have a comparative date we've pulled out that you can take a look at. But when you see here, we're into 15. This is what I was talking about. Inventories got kind of low. People thought their sales were going to go to the moon. And, we had low yields. So people bought a lot of grapes at some pretty high prices. Here's, you started to see that build a little bit. Remember we talked about what happened in 17 with shipments slowing. And then January 2019, we added in all that 2018 vintage on top of that. So that inventory is growing, and we'll talk a little bit about what that's doing to pricing. Here's where we sit today in November. Now, the challenge here is that's what we have today. We haven't loaded in 2019 inventory into that, right? So that's still coming in terms of what people crush this year, what they have available to sell. The other thing is we look at this as the tip of the iceberg because at this point, it's pretty brutal on the bulk market. So my belief is there's more than that wine around that people have to sell, but a winery might be trying to do other programs because if they try to take it to the bulk market, there's not a lot of value. So if there was a real market, if there was real buyers in there, we have more volume available to sell. So I think it's what people are showing based on the market conditions. This is kind of just taking some breakouts by particular region. This is Lake and Mendocino combined. You can see bulk gallons on the left. And then again, we've used January 2018, January 2019. That's showing you that big jump in terms of what was happening, that 18 inventory. And you see where we sit in November. By variety, the corresponding lines are prices. So the basic takeaway here is inventory's building, prices have declined rapidly from where they were just a year to 2 years ago. And at this point, we haven't seen that bottom out, or at least we don't know where that bottom will be. We're over 2 million gallons sitting here today for North Coast or Lake and Mendocino Cab. If you look at it from a Sonoma basis, this is Chard, Cab, and Pinot, same kind of trend. Volumes increasing of what's for sale. and a precipitous price decrease in terms of having the pricing it takes to move that inventory into the market. So as what somebody said, you really don't have a supply-demand problem. It just depends on what price you sell it at. So a little bit, that's, to move that inventory through the system, that's where that price is being challenged. If you just look at supply-demand, here's where we were. It's always good to look at where we were 2 years ago or 3 years ago. There's a lot of buyers buying. They needed fruit. We thought we were going to grow our brands. Sellers were going, you know what? That's not enough money. I need a little more money. They were playing hard to get, which made sense where the market sits. But the example here is that's where we were, that's not where we are. And you need to manage your business based on the reality of today's conditions, not what you hope for it to be, but what it is. So if you look at where we sit today, buyers are on the sideline. There's a few buying, not many. And if they are, I talked to a buyer today running around, they're like, I want to put, they're almost like, what's the singer that they put their thing over their head? They're like, I want to be here, but I don't want anybody to know because they're going to ask me to buy their grapes and I can't, at least not right now. A lot of sellers selling. But what's complicated the market is a couple things. So one, in terms of buyers, when everything was tight to get, prices are going up, wineries changed their sourcing strategy. They moved out of the North Coast, out of Sonoma, California brands, right? Because they could grow, there's more availability, and there was pricing. They had margin flexibility within their product. So that put pressure for things to move. And then the second thing that happened this last year is buyers aren't just not buying, buyers are selling. I go to visit a winery, I said, hey, you want to buy some grapes? You want to buy some wine? We got you. And they go, Glenn, we don't want to buy anything. Here's our list of grapes and wine we have for sale. So that was kind of, everybody was trying to look at moving out of inventory. Excuse me. I'm almost there, guys, but let me just go. This is just Sonoma County Pinot Noirs to look, but you can see this is Tony Correa. If you don't know Tony, Correa Company, probably the best ag land appraiser in the world. Well, maybe the state, we'll give them that. But you can see here that price escalation over time and the tons. This is tons of Sonoma County Pinot. So it's grown pretty fast. We've had dips before in terms of that price. We're definitely in one of those dips now. And you're going to see pressure, and this is going to look like other varieties here as we look at that going forward. There's going to be pressure on price. When you look at total crop value, which is just price paid per ton by total tons, you can see the jump up we've had. Look where we sat in 2005. It's gone up 5 times in terms of total crop value, right? More tons, price has gone up precipitously. So I think those things are going to start to change. And I know Robert, you kind of talked about, what happens in Napa. Who knows? I mean, it's like me when you didn't help me with my 401k investments. But the thing here, and according to Tony, is, wine prices drive grape prices that drive land prices. So you can see for Sonoma County, we are starting to see these grape prices start to come down, and you're potentially going to see some weakness as we go forward in some of your land value and winery value. You're going to have that affect other parts of the industry, I think, as we go through it. And those are the things I think you need to be prepared for. The other thing is you look for indicators. So this is 2009, Highway 29, right on the road. Hey, I've got Napa cab grapes for sale, right? I hadn't seen that before since 2009. Maybe everybody does that. I sure didn't think so. We sure didn't see that again. The next time we saw that again is 2019. So it gives you an idea of where we were, where we are, and comparatively. In terms of actions to take, I think it's about adjusting your expectations. It's about kind of survival. So be open to the new realities of the marketplace. We've had a number of guys I talked to. I have grapes available. Glenn, I got an offer 9 months ago. I wish I would have taken it, right? So, you can talk to people like us or whoever you want to talk to, whoever you go to for your information, but understand the market when you start negotiating price. Understand what the reality. I had a guy call me, hey, I need to sell my cab at $3,000. I go, I've got 30 people that'll sell it between $1,000 and $1,250. It doesn't mean that's the price, but it means you better have another option if that's all you can deal with. So really understand the marketplace. I think there's strength in relationships. I've been in this business a long time. I think relationships have value. So my encouragement, if you have buyers or former buyers and you're a seller, now's the time to kind of strengthen those relationships. Understand your buyers' needs. Help them meet those needs. Help them be around so they continue to buy from you. We've had a number of people, it's like, Glenn, it was a little high as sugar and I was pissed off. And I go, now's not the time to say that you lost 3% on whatever. Now's the time to, you don't let the little things bother you. Worry about having your fruit sold, your inventory placed, work moving through it. So there are inventory adjustments taking place. And I think the one thing with supply and demand that's interesting is if we don't grow supply, the best thing to do would be grow supply. I got to tell you, from a guy on this, grow demand, which would mean that supply, on the supply side, that would be the easiest thing. That may not happen. If we can't grow demand, we're already seeing people adjust supply. So inventory is changing. So here what we're seeing. People are removing vineyards. We've been talking about this, but inefficient, old, virus. We have wineries out there that are top working young vines to the variety they need, removing the old vines, changing their mix. But we're seeing vineyards removed, or maybe at least fallowed. So you're not going to bang your head against the wall for too long before you figure out you need to do something different. So we're seeing that adjustments. The other thing is, when we start talking about people, and we're still figuring this out, hey, how much wine did you make in 19? The answer is, hey, Glenn, it was brutal with the wine I made in 18. I lost my shorts. I'm not going to do that again. So there's this feeling in terms of 19 bulk wine out there. People were cautious about what they made. They just didn't make it into wine and say, this is something to do with it. They were definitely more careful in terms of what they were doing. And then the last thing here is we have an opportunity in this market, maybe not if you're the seller, but to develop some new brands, right? To try it. We're not going to have existing brands come back into Sonoma that left Sonoma, but it's a chance where we could start new brands in terms of pricing, positioning, packaging, consumer proposition. I think the challenge you have is a lot of wineries are working through that 18 inventory, and they're afraid to take their focus off of that by actually starting a new brand, which takes some money, time, and resources. But I think now's the time to look at that opportunity. So I would encourage wineries out there to, now's the time to go, hey, we can take advantage of this and move forward and really develop, that consumer proposition. So, long term, we grow our demand. We don't just sit here and kind of take it. And that's just necessity is the mother of invention. So that's what my argument would be to your sales and marketing guys, is to put a little pressure on them. I know it's not always easy. The only thing, thank you so much for your time as always. I know a few of you in this group, but the other thing is, if you don't get it, we do a California market report monthly. It's free. You can go on our website or call me, but it's pretty interesting. Gives you kind of our take on where the market sits as it changes. On a more global market, we have that too. So thank you again for your time, and hopefully enough for questions, but thank you.
Thank you, Glenn. So as you guys can see, we've invited 3 smart guys with a lot of data. But what you may not have noticed when you register for this session, there's small print that says that you have to be above average intelligence to participate here. Because we now rely on you for some very smart questions. So do we have a volunteer to start off? We have a microphone over here. There we go.
Hi, thanks for your time. I was wondering, and this could be for anybody, if there was one characteristic of kind of this whole year, whether that's fiscally or elsewise, that stood out to you or surprised you.
I guess my surprise was how quickly it hit a wall. I've seen parts of this industry where we've seen a slowdown, but I was surprised how it was. I don't care if you give it to me, I can't use the grapes. So I think that is that's as severe of a wall we've hit as I've seen in my few years of doing this. So that to me was a little surprising. I kept thinking somebody would take advantage of that opportunity for what it is, because it's an opportunity to somebody, and that surprised me how abrupt it was and how uniform. Everybody was the same. It wasn't like, a couple guys said, I got an idea, I'm going to do something. It was very interesting.
I guess on the consumer side, what I would say is that this is one of the first times where the wine category isn't competing within itself on switching between products and between brands, but you have very active engagement of the spirits category to switch people off of wine to vodka to gin to rum. So you're seeing a lot of what I didn't show you here, but the trends on the white spirits are climbing, and they're climbing at the expense of wine.
That's okay. So from my angle, I didn't expect the Federal Reserve to cut 3 times this year. I expected them to cut twice. When they cut the one in October, I say, wow, that's pretty aggressive. So what that could mean, though, and the reason I bring it up in this sense is that if we think about how the consumer is going to ultimately react, if consumers are really driving our economy right now, and you think about consumption driving the wine industry, and on the demand side of it, we need to watch very carefully how any abrupt change in 2020 could. Right now, though, there's a lot of fuel, but it could change that perspective on the consumer side, and that can have a relatively long shadow. I mean, that's something you think about the Great Recession, how long the shadow was to get out of that. If we do go into recession, it's probably going to be pretty mild, but it seems like that there's things that are being seen about where the consumer may be going, that by lowering rates and giving consumers a little bit more confidence, both on the wealth side and on the income side, that we're going to continue to move forward. That should help us, but it still kind of shocked me that it needed to be that aggressive.
Thank you. Yeah, for the last several years, we've seen a migration of winery acquisitions as they move up north, perhaps to expand varietals, climate change impact. And we've also seen a lot of the big majors come in and make some major acquisitions of acreage. What do you see happening in the next few years now as we see the demand impact?
And in north, you're talking Oregon and Washington, is that correct? I mean, I think you look at the Oregon category, and that's been growing. I would also, your argument is they're kind of more in their infancy of that development, so they're less established, right? So you kind of got to take that with a grain of salt, and when they're mature, where does that go? We look at that. I mean, I think they had some issues in terms of botrytis and some other. They didn't have the biggest crop in Oregon, right? So that market's probably going to be there. But long term, we've seen a lot of new acres go in the ground in Oregon to kind of be there ready for that supply, that demand when it comes on board. I think if this thing starts to slow down for them as they mature, they'll be in the same situation we sit in today. And there's some cost structure in Oregon where, you need to sell things for $30 and $35 a bottle to make, given their tons per acre and their costs and their risks, right? Because there's more in terms of weather issues. So that's a question to me is where's the consumer going to be? I mean, we talked about Rob, McMillan, and I keep telling him not to be so doom and gloom, but I'm working on him. But the deal is, we may see this activity be at 15 to 25, right? When this consumer kind of readjusts. It may not be at 35 and 40, or when this Gen X or millennial. So yeah, I think the other thing they're looking for ways to expand their portfolio, right? So Oregon Pinot has some resonance. I think you look at the Washington market, and you've seen the biggest buyer up there, and they've started to pull away. So they were very aggressive. You go up there 3 years ago, and they've had their challenge, and they're 60% or so of that marketplace. So they pulled back a little bit too. So I don't think anybody's immune from what's going on. And we're probably, I think you were talking about we're going to see some more consolidation. I mean, there's going to be some things as we go through this next couple years. People are going to take different strategies. But good question, because I think it's something you're seeing. So yeah, excellent.
Oh, thanks, guys. Rob and Glenn, I was wondering how much of an impact the export market has been in terms of the tariffs, and it's interesting to hear about all the effects that I've gotten and heard from you, Glenn. Do you think it's more of like the millennial buyer is just not as interested in the product, and that's what's driving so much more inventory? Or do you think it's something that's going to rebound in the coming years? And then Mike, for vineyard owners in markets across the country, how can they find value in new markets through the data that you're providing?
So the last question had to do with, as vineyard owners, how to think about expanding into other markets. And I think that one of the points I was trying to bring across is that strategies where you move into a state and then try to sell into the whole state, when you're small, when you're new, don't work as well anymore because within every state there are a lot of regulatory changes going on, whether everything from the direct-to-consumer just down to things that you wouldn't think affect you, but shifts in what stores can sell, grocery stores and others can sell now affect liquor stores, which means they're in a very, they're trying to figure out what their future looks like and what they ought to be selling. And so what we do is try to parse up those state markets into much more specific, smaller markets that are targeted better to your type of product. And so if you can get a handle around who the buyer is for your product, we can find, and our data help find those kinds of buyers across the country and let you build a plan for more targeted expansion of the business rather than just trying to scale production and sell into multiple states.
Yeah, and we can talk about, I mean, the export, maybe both. You know, this question about, I think the first part of it was, maybe that's for Robert, this whole growth of, but I think on the export end, you know, we look at into China, you made some comments about it's a tough market, right? But the people that are doing well in China in terms of moving wine are those that are free trade. They don't have that tariff burden. So you start looking at Australian wine on a bulk level's held up pretty well. Their industry has lived on, you know, exports into Asia. Chile, where we have an office, we do a lot of work with bringing Chilean wine into China. And is mentioned France. Those are kind of the three areas of growth. France has been there a long time. That's more of a long-term investment. When you look at the other two, it's because of how that trade, that tariff type things work. I think when you look at China on case goods, because I know this question about tariffs and all that, we don't sell that much wine into China in general, as a case good from the U.S. So I think more people are worried about the future growth. That's a future opportunity that maybe we're starting to throttle down because of how we're positioning ourselves. I think the other thing when you go about it, I mean, we used to sell a lot of California bulk wine internationally. It would go over to the UK, it'd be bottled in Germany, sold in the UK market. California wine's expensive. I mean, and I know people go, Glenn, I heard the grapes, it's really short in Australia or whatever the place, and that's going to affect us here. How's that going to help us? That's not a one-to-one transition. It's hard because it's different pricing, different markets. So international's tough. I mean, it's because we are not cost advantage. And and the other thing, we've talked about this before, the number one wine market in the world is you're sitting in it, right? In terms of sales and value. Everybody wants to come here and eat your lunch. So that's the other challenge to it is, they're not leaving you alone. So.
Yeah, so I'm on the board of a company that sells sort of curated luxury wines. One of our biggest problems in terms of markets and exports and where we're going next is, are people going to now fill their cellars and they're done? So we've had such a long, smooth run since the Great Recession. People said, okay, so I kind of stopped buying for a while. Now I'm going to start walking back a price point. And now I'm looking at my 1,200 bottle cellar and it's full. So I'm going to shut the faucet off for a while. Well, if that happens in general because everybody's sort of climbed up and peaked, that I think is where the real challenge lies, because the wealth is there, the income's there, and all the great demographics you want in long-term wine buyers. You just need them going a bottle a night at $400 a bottle to clear it and start stuffing it back in there. You know what I'm saying? Because I think to me that's the thing, is you're going to see whether or not that market continues. I think you've seen a lot of wine clubs sort of living off those kind of folks for a while, and it's just been this sort of lather, rinse, repeat play. How much longer that can go without thinking of a different market, thinking more international, or just thinking about general diversity and segmentation. A lot of smaller wineries don't think in those terms. They're just saying, let's just keep grinding, taking them on the cruise, bringing them here, bringing in the celebrity chefs, and turn it over again and hope to Christ next year it works out. We're in a position where we source wine from all over the world, and we're thinking about that.
From a cultural perspective, why are millennials drinking less? And can you speak to the abstinence movement?
Yeah, we're giving it to you. You're the guy.
On abstinence, okay. Not sure I can speak to the abstinence movement. We don't pick up non-drinkers in our data, but what I can tell you is that, and it goes back to what I was saying, there is a shift. I mean, you read about this, but we actually see it in the data as well. There's a shift away from wine at dinner to cocktails at dinner. Like there's a very active strategic marketing effort of the spirits industry to displace wine. And the wines they're displacing aren't the big brand names. They're the wines that people used to be buying, and now they're trying, craft tequilas or craft vodkas because it's different and it's a change. And the millennial crowd in general likes that diversity and that constant trial of new products. Now, what you see from at least some of the research on this is that as the millennial segment ages, they will start to behave more like the Gen Xers that are in that category today, that they will start to slow down that variety and they'll start to settle into some level of consistency in buying, but that's still several years away. And so you're still dealing with a segment of the market that frankly has more affluence than prior generations at the same age did. And you're seeing many, many more opportunities in front of them to choose from and to try different things. And so it affects the competitiveness of any given category.
I have the dubious distinction of probably being one of the oldest guys in the room, but the only advantage to that I can see is that I've got a long memory. And this may be to any of you. In one of the most severe recessions that we had in the wine industry, a guy by the name of Fred Franzia came up with $2 Chuck, and that fits into one of the possible solutions. Do you see the emergence of the equivalent of somebody like that to scoop up a huge amount of the inventory at low price? And I think we brought new consumers in with that at the same time. So it may have the solution to two problems, brand growth and consumption growth.
Yeah, no, I mean, I think I'm hopeful we're going to see some creativity, to move us forward. And, that was kind of a unique positioning with price. I can tell you most of the buyers we see right now in the bulk market are, because, most of the major wineries have their own inventory, are people that are private label. So we've seen some interesting thing, try to be developed, right? New products, or at least, in different markets, trying to get price down. So I think we're going to see things develop. To me, it's how do you connect with this millennial and Gen Xers? So can we, they seem to be at least a different breed. They may change and be just like baby boomers, right? But they're looking for authenticity. They're looking for travel. They're looking for, health. They're looking for simple, ingredient. I saw the beer the other day. It's got 4 ingredients on it. That's how it's marketed. You go to White Claw. I think we need to look. To me, our answer probably isn't, and this could be sacrilege, but it's probably not another $7.50 with a pretty label that's cork finished, right? It might be, but are there other ways? I think that can we be creative in some ways? The wine industry, you saw that growth we've had since the 1990s. We're pretty provincial, right, in what we do. Is there a different way of looking at that business? That takes risk and it's an unknown, but it may be us looking at things differently too this time that takes us to those type of solutions. So I think some risk will be rewarded, some will be penalized, but I think it's now the time to take a risk in terms of how you have your consumer proposition to that upcoming generation. The one thing I wanted, you mentioned before, but my father-in-law, and I benefit from him, he's 82, retired doctor, had a 4,000 bottle Bordeaux and Burgundy collection, right? He has some of those, and he goes, Glenn, I'm done buying the wine. I want to be able to drink it all. So I just try to show up with him and drink it. But it's like, he had this beautiful collection, but he's not buying more, right? Because he wants to enjoy all that he's bought. So it's just, add to what you were talking about.
Well, and I think from an innovation standpoint for the wine industry, the biggest challenge is are you creating gateways? So I think the court's still out on whether or not $2 Chuck created a gateway toward higher priced wines over time. I don't know if we have really a solution on that one, but if the bulk wine market continues to have a lot of inventory, you're going to see some innovation just simply to blow it out and potentially roll the dice, just what Glenn said, on how can we maybe grab on to somebody that we can pull up that price point ladder later. If it doesn't linger for too long, you may not see as much of that innovation. It might be just more of a blowout situation, but we'll see how it plays. I think it's something that there may be an actual strategic opportunity here that looks like a strategic challenge on the surface that it could evolve in a positive way for the industry. But everything Glenn says is spot on. I mean, it's becoming a more competitive market every day, and the more provincial you are about the way you look at your customer base, the more tricky it's going to be to grab on new people later.